afternoon. Bob talked a little bit about some of the macroeconomic factors affecting the industry, and Bryn dove down into the firm level stuff. I'm going to operate in the middle, and I was involved in some of the firm level stuff, but basically at Ivey we have three major pieces of research on the food industry, and my postdoc here, Nicoletta, has got another one sort of on innovation. The things that we are looking at right now are, we want to know how is this industry performing, because when you hear things like a $6 billion trade deficit and Leamington closing, Heinz in Leamington, Kellogg's in London, all of a sudden you get one picture of the industry. We just want to make sure that picture is accurate. The second thing that we did was we said part of the industry is changing, and those closures are part of that change, but we want to understand that. So we looked at that part of the industry that is actually going through some structural change. So we did an event study there. And the last thing that we've done are firm level case studies, and we've done them working with Bryn and David, but we also at Ivey have Paul Booth from our Lawrence Center. We're working, a bunch of us are working on the future of manufacturing in Canada, and so we've got some work looking at that. So I'm going to take you through the first two pieces, the industry performance and the event study, and you'll get a sense of what's in those are each papers. You'll get a sense of what's in those, but there's still a fair amount missing. So Canadian food manufacturers, we know, are under pressure. Input costs have been rising since 2007, 2008. Retail, much more concentrated, targets in. We've got a lot of foreign competition, and that's partly because of the Canadian dollar. And then we have this new set of pressures where consumers are saying, we care more about our health, we want to know what's in the ingredients, and tell me a little bit more about the sustainability, and oh, by the way, this better be at a really competitive price. Tough place to play. But when we look at Canadian food manufacturers compared to the other top, so this is the top 5 manufacturing sectors in Canada. Revenue for the Canadian food manufacturing doesn't look at all like the other sectors. Every year it seems to just keep increasing really gradually while everybody else goes through whatever. Richard this morning talked a little bit about the inelastic demand for food. Well, I think we're seeing it to some extent there. So number 2 in terms of revenue in Canada, that was in 2011. The food manufacturing industry has been the #1 manufacturing employer in Canada for years. And that's a fact that seems to not get talked about very much at all. And we did dip a little bit sort of in 2006, 2007, but then recovered through the recession when everybody else was losing people. Essentially, transportation, which includes auto, aerospace, ships, trains, etc., they saw a 25% drop in revenue and a 25% drop in employment. They have been recovering, but still, food is the #1 employer in Canada. That's an important fact. We're also seeing a shift in the nature of that employment, not a big shift. So the blue line represents direct manufacturing jobs, the red portion, indirect jobs, so not on the line. And what we've seen is during the period we studied, 2004 to 2011, we lost about 5,200 manufacturing jobs and gained about 8,700 indirect jobs for about 1%, not quite 1.5% gain over the entire period. So interesting from that perspective. When you start to look, you can see manufacturing revenue's been going up, but expenses have been going up as well, the purple bar. And when we sort of take a look at, well, what does it mean in terms of industry profitability? Because things sound pretty bad. The blue line, again, is food. And the blue line's doing what the food industry seems to do, gradually increasing with some variability in terms of net profit, while everybody else got hammered during that the latest recession. So it is an interesting industry from that perspective, and that steadiness, when you're in the middle of a recession, being slow and steady becomes really exciting. When we look at value added per employee, food is a relatively low value commodity with lots of labor. And so you look at that line, food manufacturing is right at the bottom in terms of manufacturing value added per employee. Over the period, though, there was an increase in productivity that puts food in about the middle of the pack when we looked at beginning and end comparisons. So there has been an increase in productivity. Part of that, I think, is starting to come from the investment in equipment. So this is food manufacturing investment, the top line is sort of total assets. But what we can see is that there's been a relatively significant increase, especially in the last 2 or 3 years, in investment in equipment. So the industry is going to look different. Now, I don't think that all of those investments are paying off yet because a lot of those factories are still just gearing up. All the stuff that Maple Leaf's doing isn't in place fully yet. One of the things we also did was we looked at regional changes. And when you look at the regions across Canada, you can see revenue increases that are fairly, substantial right across the entire country, except for the Atlantic region. Interestingly, though, the employment picture doesn't look quite like that. We see gains in Quebec and British Columbia, but Ontario's pretty flat and basically lower than they were back in 2004, in spite of that significant increase in revenue. And the Prairies, Atlantic, again, just not that much. So the net gain over the entire period was really happening mostly in Quebec and in British Columbia. One of the things that, when you think about the food industry, the Pareto principle applies. The less than 50 firms with fewer than 50 employees, 84% of the firms producing just 17% of the total production. So we were interested in this other 16% who produce 83% of the total revenue for the industry. And we started to look at when we looked at the openings and closings, we'll delve into that group a little bit more. When you think just about closings, and this research actually came about because Food and Consumer Products of Canada had a board meeting, called me up afterwards and said, our directors are asking about all of these closings we're hearing about. What can you tell me? And I said, I really can't tell you very much, but we might be interested in looking into it. So we have been looking into it. When we started looking into it, this is what we saw. But then we thought, well, that's a pretty incomplete picture. How can you talk about closings when you don't talk about openings? So then we added that. And then we heard about some of the investments that firms were making, and we thought, well, we better add those. Picture looks dramatically different when you start to think about both openings and investments, the red and green, compared to the blue. So the industry had a tough time in 2007, which is when the dollar was high and commodity prices started to go up. But since then, it's actually shown a pretty positive trend. And the closings tend to be usually older, smaller, less productive facilities. So then we thought we better delve into this a bit more. When we looked at whether these closings were single plants going out of business forever or part of multi-plant companies who are restructuring to be more competitive, what we found was almost 90% of the closings were in multi-plant facilities. And so the industry is restructuring. We asked, or we either asked or we found the sort of secondary sources that we tried to tease out, why did these plants close? And we said, what's the main reason these plants close? And the red is what's the secondary reason? Essentially, you see two big things. No longer competitive, and we're consolidating our production at another facility. So a lot of the closures were that. Some of them moved outside of Canada, but mostly this was a reorganization, taking out some older facilities and moving production around. I'll just give you one little bit from our case studies, but when we sort of talked to companies about what they were doing and how they were managing their business, what we heard was companies are really aware of their need to compete on a global basis. So everything they do, the large ones, is about being globally competitive. And part of that is having a manufacturing base that really supports relatively low-cost, efficient production. So companies are focused on increasing their scale. They're focused on putting more automation. A lot of them are going into robotics, testing out systems. And we saw almost every company we talked to was reorganizing its information system, adopting enterprise software systems to really integrate everything across the entire organization. Much more focus on value maximization. Let's take apart everything we bring into our facilities and figure out where we can extract the most value from that, and sometimes that means non-traditional markets. Bryn talked a little bit about the importance of innovation, and innovation tended to be both products and processes, and often supported by some organizational change as well on top of that. As always, food companies were very focused on food safety, and that was a big part of what they were investing in. How do we make sure that our products are as safe as they can possibly be, and use new technologies around that? So to get to Doug's question on what's the difference between foreign and multinationals and Canadian, so we took and divided our sample of very large companies into foreign and Canadian owned, and you can see that the foreign multinationals tended to be exiting a lot, sort of in 2002, and consolidating a lot in 2007, 2008, 2009. And then they started to invest. We've seen some investment, which is actually quite surprising because the dollar was pretty high then, but we saw a fair amount of investment happening at that time. The Canadian picture looks a lot different. Not nearly as many closings. Certain amount of restructuring and a lot more opening investment, but not in the same numbers as the foreign multinationals. When we looked at it by province and said, well, what are the foreign multinationals doing by province? What you can see is essentially almost all of the closures are in Ontario and Quebec. But Quebec sort of balanced out by attracting a number of new plants and some investments. They attracted 4 investments, new plant openings from French firms. So that relationship between Quebec and France proved to be relatively strong. When we looked at what Canadian multinationals are doing by province, what we saw is that they did reinvest. When I see my font did actually shift, which happens sometimes when I move. So, but Canadian multinationals by province, lots of restructuring in Ontario and in Quebec, lots of investment, particularly in Quebec. So the Quebec story is one that I think we need to investigate further because they've been quite successful over this period of time. So our major conclusions, and this is just really quick, high-level sort of overview of what we saw. First of all, if you think about food manufacturing from either a GDP perspective or from a jobs perspective, it's an important industry for the country. If you think about it from buying, a lot of the Canadian farm products, it's also important. So, food manufacturing is completely different from other sectors, and that's one of the things that we need to be aware of. That slow, steady, but resilient is important to the country. It is an industry that is experiencing pressure, and so it is changing. Global competitiveness is just, that's what the executives talk about, and so they are upgrading to do that, but my impression was there's still lots to do, and we're going to still see more change in the future. And the last part was that comparison between large Canadian firms and multinationals, and what you see, which makes sense, Canadian firms are a lot more likely to stay and to invest than foreign multinationals. We just had a call with some of the board members at Food and Consumer Products Canada, and we were talking about, well, what does this new environment mean? Because the industry in 2004 was just in the middle of watching the dollar increase. And I've had executives say things weren't really too tough in the late 90s while we had a really low dollar. And so we weren't as competitive as we were. We've watched the industry go through a very tough period of time, a very tough period of competition, and they've become leaner. They're adopting lean manufacturing methods. They're bringing in new technology. And so the industry today is very different from the industry 10 years ago. And we're now in a situation where the dollar's dropped back down to the 97 level. It looks like it's going to stay there for a little while. And so the question that we really have to ask ourselves, from an industry perspective, from a policy perspective, how do we take full advantage of the new industry capabilities in this environment, in this completely changed environment? And I think if we do this right, we don't want to be talking about an industry with slow, steady growth. I think we want to talk about an industry with pretty exciting growth. So thank you very much.